Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. As always, I'm glad you're here. Thanks for joining me today for this episode. And we're going to talk about how to navigate market volatility without losing your cool. So volatility is a natural part of investing. I like to say it's the price of admission that we pay in exchange for the opportunity to grow wealth over time. But when markets start to swing up and down, especially down, it can be really easy to let your emotions take over and get really uncomfortable with that. So why does volatility happen? What does it mean for long-term investors? And how can you position yourself to stay confident and grounded through those market ups and downs? So first, what's market volatility? Volatility refers to the big moves up and down that we see in the stock market. It's the reason we get headlines like stock plunge amid global uncertainty one day and markets rally on economic optimism the next. A lot of investors tend to enjoy the ride up. It's nice to see stocks go up, but when the market drops, fear can take over at that point. So many investors kind of start to ask, what should I do when the markets get rocky? What do I do when I'm scared about this? So one of the keys is understanding volatility and building a plan around it. So why does the market swing so much? Why do we see these ups and downs? So markets are information processing machines. So when new data, for example, like changes in interest rates, geopolitical developments, corporate earnings, when new data like this enters the system, prices adjust to reflect it. And this adjustment is happening constantly. Sometimes it's subtle, it's minor and almost unnoticeable, and other times it can be dramatic. For example, during a period of higher uncertainty in early 2025, the market dropped nearly 5% in a day, followed by another 6% drop the next day. But then only a few days later, it rebounded more than 9%. Those swings weren't just random. They were the result of investors absorbing and reacting to new information, including policy shifts and economic outlooks at the time. High trading volumes during those times confirm the markets were actively processing new realities. And that's not chaos, it's how the market is designed to work. So let's talk a little bit about the emotional cost of volatility. So seeing your portfolio drop sharply over a few days is not fun. It's never comfortable to see that. And if you're not prepared for it, it's easy to make emotional decisions that can derail those long-term plans. And so that's where it's helpful to have some perspective around the big picture. So let's talk about a few numbers here. So on average, the S&P 500 sees about 3 pullbacks or drops in value per year. That's just on average. And not every year is going to have 3, but on average, we see about 3 per year. However, when we zoom out, the S&P 500 has produced positive calendar year returns approximately 75% of the time since 1926. So that history reinforces a pretty powerful point. Markets go up and down, but over time, they tend to go up more often. If you let your emotions take over and focus on the short-term drops in the market by selling off your investments, you run the risk of missing the gains that often follow. So let's talk about how missing the rebounds can hurt. The real risk of selling during a downturn isn't just locking in the losses, it's missing the recovery as well. So let's look at the beginning of 2025 as an example. At the end of April, the year-to-date return for the S&P 500 was negative by over 5%. Then just 1 month later, it was up approximately 1% year-to-date. 3 months later, it was up over 8% year-to-date. And by the end of August, the S&P 500 was up over 10% year-to-date. So if you exited the market in fear during that time, you would have missed that recovery. And that kind of rebound isn't unusual. Historically, many of the best days in the market happen close to the worst ones. So selling off at the wrong time can dramatically damage your long-term returns. So one mantra to think about is expect the unexpected. One of the most useful mindsets for investors is this mantra, to expect the unexpected. No year in the market is normal. There's nothing that is normal about any given year. There's always something happening. There's economic data, policy changes, geopolitical events, and often those developments will create some turbulence. But just because the headlines are noisy doesn't mean your financial plan needs to be noisy. Lots of headlines are out there making noise, trying to get you scared, but that doesn't mean you should be reacting to that. So a good example is the year 2023. There was a year filled with financial, political concerns, lots of headlines. But in the year 2023, despite all those headlines and concerns, the S&P returned over 25%. It's a reminder the market often performs better than the news cycle might be suggesting or trying to scare you into thinking. So it's also useful to know yourself as an investor. So the right asset allocation is the one you can stick with. It's not about chasing the highest return. It's about aligning your investments with your risk tolerance and your goals. So for some, that might mean holding more equities and just riding out the volatility, being okay with it. For others, it might mean a more conservative allocation with fixed income or even cash assets or cash-like assets. The key is to understand your emotional threshold and then plan accordingly. So someone who can't sleep at night during downturns might be better off with less exposure to stocks, even if that means giving up some potential upside. Peace of mind has value as well. So preparation is really helpful to overcoming reacting to these things. So the best time to plan for volatility is before it hits. So things like setting realistic expectations about market behavior. It's important you understand how and why the market behaves like it does. And then choosing an asset allocation that matches your comfort level. It's okay to be more conservative if that matches your comfort level and that helps you sleep at night. And then committing to that plan even when things get rocky. So setting up a plan and then committing to sticking with it even when the markets go up and down. It's kind of like an explorer. If you think of yourself as like an old time explorer preparing for a long journey, you've got the right mindset, the right tools, and the right preparation to make sure you complete that journey successfully, knowing things are going to come up along the way. So there's another useful perspective I like to talk about, which is when do you plan to use the money? So this is a really useful framework to have when you're thinking about investing. And again, that is the phrase, when do I plan to use this money? And that question alone can determine a lot of your investment strategy. JP Morgan publishes an annual guide to the markets, which is really full of great information. And it contains, among other things, a useful perspective on how the market behaves over different time periods. So in this guide, we find the following statistics about the S&P 500 from the year 1950 to 1924. In any given one-year time period, returns have been as high as 52% and as low as negative 37%. So in a one-year time period, we can see a lot of variation. It can be very positive or very negative. However, when we zoom out to any given 5-year period, returns have been as high as 29% and as low as negative 2%. So look at that spread already compressing in 5 years. In a 5-year rolling time period, in any given period, again, as high as 29%, which is great. 29% is a pretty good return, but only as low as negative 2%. In any given 10-year period, returns have been as high as 20% and as low as negative 1%. So again, we're almost to the point where, very little chance of a low return. And even that low return has been negative 1%. And then finally, in any given 20-year time period, returns have been as high as 18% and as low as 6%. That's positive 6%. So in a 20-year time period, the market has always seen a positive return. So as you can see, your chances of a positive return dramatically improve with time, and your chances for a negative return decrease substantially as well. So if you're investing money that's not designed to be used for 20 years or more, this should give you some confidence. So as always, again, the mantra you've probably heard before is stick to the plan. It's hard to do. It's not easy just to snap your fingers and stick to the plan. But volatility is not a sign that something is broken. It's a sign the market is doing its job, which is responding to change. That's normal. That is how the market is designed to work. So it can be uncomfortable, but it's also what creates the opportunity to build wealth. When we stay the course through that turbulence, we really give ourselves a chance to benefit from the market's long-term potential growth. Because over time, despite those bumps along the way, markets really have tended to reward patience. So keep that in mind, stay patient, stick to the plan, understand how markets work, and that should help you be more comfortable as an investor. All right. Thanks so much for joining me. As always, you can find me on the web at elevationfinancial.com. That is my website. It's got a ton of information on there, including this podcast and blog posts and stuff like that. And you can reach out to me on my website, or you can book a free consultation if you want to chat in real time. And again, that's at elevationfinancial.com. Thanks for joining me today. As always, have a great day. We'll see you next time.